Hello. Yeah, we can. Okay. Good evening, dear students. How are you all? So we recently had our uh, CA exam results on Sunday morning, right? So I can just imagine, the happiness that students, the successful students, would have got uh, right in the morning of Sunday. So we are here all assembled today to discuss uh, sort of revision for the topic of ratio analysis. It pertains to financial management, paper 6A of CA intermediate exams. Okay. So this is like, these are the topics which we have covered in detail in our regular sessions. And what are we really interested right now is, undertaking revisionary sessions or some revision part of it, wherein we'll be doing a good number of practical questions. Okay, so we'll be doing like good number of practical questions with regards to this topic of ratio analysis. Okay, so we'll be doing the questions which are relevant with regards to, we'll be doing questions from some of the model test papers and past question papers. Okay, so that you get a real life experience about what sort of questions are expected in the exams. Okay, so that's how we are going to proceed for. Okay, so this topic of ratio analysis, it's very easy, as well as sometimes the questions can be quite tricky because you need to be very thorough with all the ratios. Now, obviously, I would expect everyone to be aware of all the ratios that we have seen in our study material. So all the ratios that we have in the study material should be, it should be completely clear in your mind, and there shouldn't be any second thought attached to that. So we can definitely take up this topic ratio analysis with ease if we are good with the ratios. Okay. So prerequisite for this topic is to remember all the topics. I mean, remember all the ratio analysis part, right? So basically the ratios, you need to remember these ratios before we start with the questions. Okay, that's the assumption which I'm carrying on. In case if you're not thorough with the ratio analysis and the ratios, just keep the study material in front of you. Keep it handy so that you can access it easily whenever we are using any sort of ratios. Okay, so let us take up a question from this Jan 2025. This is a Jan 2025 paper, wherein we have got the ratio analysis part. In this question number, let me just check it. Where is that question? Present value. Yeah, this is there in the question number 3B part. Okay, so we are supposed to prepare the balance sheet. So let me just take this question, or let me do one thing. I'll just use my technique which I've got over here to be. Okay, here we have this B part. The equity share capital of Skypack Limited as on 31st March 2024 was. So as on 31st March 2024, we have got the share capital of 2 lakh. The relevant ratios of the companies are given. You can see all the ratios are given. So we've got the ratios like we've got the current debt to total debt to owner's equity, fixed assets to owner's equity, total asset turnover, inventory turnover. We are required to prepare balance sheet of Skypack Limited as on 31st March 2024. Okay, so we've got to prepare the balance sheet. So equity share capital as on 31st March is 2 lakh, and rest all things have been given in the form of ratios, and we are supposed to prepare the balance sheet. Now remember, whenever we have this sort of questions wherein we are required to prepare a balance sheet, okay, when we require to prepare a balance sheet, we are supposed to be, you know, preparing the pro forma of the balance sheet in front of us with whatever items of balance sheet possible, filling it up. Okay, so we can definitely go with a T format. There's no harm in that. So we're recording it as liabilities and assets. Mhm. Okay, so we've got the liabilities and the assets. Okay. So always remember to prepare a pro forma balance sheet so that we are having some sort of direction as to what we need to compute. Now, if we look at the question, we've got the information of equity share capital to be 2 lakh. So let's just put that entry over here. We have equity share capital of 2 lakh, right? Equity share capital of 2 lakh. Rest, let's look at the ratios to identify what all numbers others do we have. So current debt to total debt is 0.35. Total debt to owner's equity is 0.65. Fixed asset to owner's equity, again, it's 0.55. Total asset turnover is given. Inventory turnover is given. Right now, we have to prepare this entire balance sheet. So now from this, obviously, we can say total debt to owner's equity is 0.65. Fixed assets to owner's equity is 0.55. Now, do we see any sort of information with regards to um, hmm, do we see any sort of information with regards to the reserves? Any hint, any idea from these reserves that you can think of? Because we've got the equity share capital, but we don't have, like, we have total asset, total inventory. Now, asset turnover is basically dependent on um, sales and the assets, and inventory turnover is based on your COGS, or fixed asset to owner's equity, total debt, and rest all, nothing is specifically given to us. Now, how do we go about solving this? Because we have, like, current debt to total debt is given. Total debt to owner's equity is 0.65. Now, we don't have information about, what is there for uh, reserves. So there's no information of reserves, but definitely we have total debt to owner's equity. And also we have current debt to total debt, which is 0.35. So current debt to total debt is 0.35 given. So we have something like current debt and even the non-current debt, right? So that bifurcation is what we can definitely make out from here. So we'll say long-term debt and also current debt. Okay. Then fixed asset, we've got the fixed asset value, fixed assets. And in that, we've got the fixed assets and the inventory turnover also to be given, or the inventory turnover is also given to be 10 times, and fixed asset, I mean, total asset turnover is given to be 2.5 times. So definitely we can get the value of inventory, and the remaining part can also be said to be other assets if there is something, balance sheet, balancing figure that we have. So how do we start this ratio? I mean, solving this question. So try to get a ratio, try to work with a ratio wherein this particular number, which is the number given to us, which is 2 lakh, that is going to be used. Now, where are we going to use this 2 lakh, share capital of 2 lakh? So only ratio which you can observe is we have got the total debt to owner's equity and fixed asset to owner's equity. Only these two ratios are given. So using these two ratios, we can definitely get the total debt and the fixed assets. Let's try to get that first, guys. We use total debt to equity, total debt to equity is 0.65. Of course, since there's no information of reserves, I'll take whatever equity share capital we have, that itself is the reserves. So total debt is something which we want to compute, right? By taking the debt, equity value to be 2 lakh. This is 0.65. So what will be the value of total debt? Total debt will be 0.65 into 2 lakh, which is going to be equal to 1 lakh 30,000, right? So 1 lakh 30,000 is your total debt. Now remember, when we have got the value of total debt, we also have another ratio called as current debt to total debt is 0.35. So we can definitely then say, since current debt upon total debt, current debt upon total debt is 0.35, right? Therefore, current debt is going to be something that we can compute. So it's like current debt upon total debt value is already we know, which is 1 lakh 30,000. So that's how we get the current debt value. Current debt is 0.35 into 1 lakh 30,000. So that 0.35 into 1 lakh 30,000, which is 45,500. Current debt is working out to be 45,500. We can write this as 45,500. And then we can definitely say long-term debt. Long-term debt will be total debt minus current debt. Total debt minus current debt. So total debt is 1 lakh 30,000 minus current debt of 45,500. So long-term debt is 84,500. Okay. Right. So that's 84. 400 is a long-term debt. 84,500 is the long-term debt value. Okay. So total, this works out to be 2 lakh plus 84,500 plus 45,500, which is 3 lakh 30,000 is the total of all liabilities. Now let's use the fixed asset value, fixed asset ratio. The fixed asset ratio is fixed asset to owner's equity is 0.55. So we have got fixed assets upon equity is 0.55. Now owner's equity is 2 lakh. So fixed asset upon 2 lakh is 0.55. So you have got the fixed asset value is equal to 1 lakh 10,000. Fixed asset works out to be 1 lakh 10,000. Okay. Coming to inventory and other assets now. Now, total asset turnover is 2.5 times. Inventory turnover is 10 times. Now, how do I get the inventory value? For that, we'll need to take help of total asset turnover ratio. Total asset turnover is 2.5 times. Of course, this total assets, when we say if it's 2.5 times, it means this is going to be sales upon total asset, which is 2.5. So sales is something which we don't know, or let us take this as based on maybe cost of goods sold, right? Because we'll be using that for the stock or for the inventory because we don't have the information of gross profit ratio. So it's going to be COGS upon total assets. Now we can definitely say that the total assets is going to be 3,30,000, which is because whatever is the value of asset, it's going to be the same as the value of the liabilities. So 3,30,000 is the total assets, which is equal to 2.5. And therefore, we can say COGS is 2.5 into 3,30,000, which is 8,25,000. Okay. So COGS is working out to be 8,25,000. Now, based on COGS of 8,25,000, based on COGS of 8,25,000, we can get the inventory because we have to keep, you know, the inventory turnover is 10 times. So we have the inventory turnover to be 10, which means COGS upon inventory is 10. So since COGS is 8,25,000 upon inventory is 10, so what will be the value of the inventory? Therefore, inventory will be 82,500. Right? So inventory is 82,500. Now we can definitely say this other assets will be like a balancing figure. Other asset is going to be like a balancing figure. So we can definitely say that balancing figure is 3,30,000 minus 1,10,000 minus 82,500, which is 1,37,500. Okay. 1,37,500. That's the balancing figure, which we can definitely say as the other assets part. Okay. So that's how we got the solution for this particular question. Are we good with this, everyone? Any queries in this question? Any queries in this question? Yes. If you write cash is it is okay. Ideally, you shouldn't say it because this can be even debtors also, right? So if you write that as cash, that may not be appropriate. It's better to keep the generic term of other assets. Okay, fine, perfect. Great, guys. So that was this question on ratio, which was from the Jan 25 paper. Now, let us go for another question from September attempt, September 2024 attempt. Okay, we have the question over here. Yes, this particular question. C. Following information relates to MNP Limited for the year ended 31st March, inventory turnover. So I just want you to go through this question. And would you like to solve it for a period of, let's say, around roughly try to solve it within, let's say, 3 to 4 minutes? You like to do it or you want me to solve it? Yeah. You solve it? Okay. So let's just give you time, maybe around 4 minutes. Yeah. Just take a moment, take around 4 minutes. I'll just start a timer over here that we'll have a proper record of it. Yeah. So 4 minute timer starts now. Missed out the creation. Just give me a moment. I'll share the screen again. Yeah. So here we have the timer ongoing and wait 1 second. Let's start again. Yeah. Just try to solve it in rough. Need not be in full form. Just try to solve it in rough. Can you see the screen now, guys? Yeah. Okay. One is 2.5 times. Long-term debt to shareholders fund is 0.6 is to 1. Debtors collection period is 30 days and gross profit is given 25% of sales. Current ratio is 2.9 is to 1. The best part is we've got the balance sheet format ready available with us. So we know what all things we need to compute. We need to compute the long-term debt. We need to compute the fixed asset, inventory, debtor, and cash. We require to complete the balance sheet of MNP Limited as on 31st March 2024. Assume a 360-day year and all sales are credit sales. Okay. If we assume that all sales are credit sales, we are going to compute this particular balance sheet. Okay. Now, inventory turnover ratio, which is based on cost of goods sold. We don't know what's the cost of goods sold, right? So, total asset turnover, again, this will be based on sales. We don't know what is the sales. Debtors collection period is given as 30 days. Long-term debt is given as 0.6 is to 1. Gross profit ratio is 25% of sales. Current ratio is 2.9. Now, this 2.9 is to 1 is given. So, how do we get all these numbers accordingly, guys, right? So, we can definitely know what's the long-term debt. That is again not known to us, but we can calculate this long-term debt from here, right? Long-term debt to shareholders funds, right? So let us use this ratio of long-term debt to shareholders funds. Long-term debt upon shareholders funds. Long-term debt to shareholders funds. This is given as 0.6 is to 1. Now, we don't know the long-term debt, but we know the shareholders fund. Shareholders funds comprise of equity share capital and reserves and surplus. So equity share capital and reserves and surplus is totaling up to 9 lakh. This is 6 lakh plus 3 lakh, which is 9 lakh. That's equal to 0.6. So long-term debt is 9 lakh into 0.6, which is 5 lakh 40,000. You've got the long-term debt to be 5 lakh 40,000, and therefore total liabilities is going to be the total of share capital, reserves and surplus, debt, and creditors. So we've got the total liabilities number to be equity share capital 6 lakh plus reserves of 3 lakh plus long-term debt of 5 lakh 40,000 and plus creditors of 3 lakh. So the total of all liabilities works out to be 6 plus 3 plus 3, 12 plus 12, 17 lakh 40,000. Right? 17 lakh 40,000 is the total liabilities. Right? So total liabilities is 17 lakh 40,000. Okay, so total liabilities works out to be 17 lakh 40,000. Now, we can definitely say that whatever is a total liability, that itself is going to be the total assets, right? So this itself is total assets. Now we can use which ratio? Total asset turnover ratio. Total assets turnover ratio. Total assets turnover ratio is going to be, now we haven't specified anything, so it's going to be sales upon total assets, right? So we don't know the value of sales, but we know the total asset turnover is 2.5. And so sales upon total assets is 17 lakh 40,000, which is 2.5. And therefore, we can say that the sales value is 2.5 into 17 lakh 40,000. 2.5 into 17 lakh 40,000, which is 43 lakh 50,000. 2.5 times. So sales is going to be 43 lakh 50,000. Now we have the information of gross profit. Now, if the gross profit is 25%, how much is going to be the COGS? Cost of goods sold will be sales multiplied by 1 minus GP ratio, which is 43 lakh 50,000 into 1 minus gross profit ratio is 25%. So 1 minus 0.25 into 0.75. So this is 32 lakh 62,500. 43 lakh 50,000 into 75% basically. So that's your COGS, which is 32 lakh 62,500. 32 lakh 62,500. That's the COGS. Okay, so 32 lakh 62,500 is the COGS. Now, based on COGS, we can definitely get the inventory value. Now, inventory turnover is 7.5 times. We have the inventory turnover is 7.5 times. Now, this inventory of 7.5 times is calculated as cost of goods sold upon inventory, right? So this is 7.5 equal to cost of goods sold is 32 lakh 62,500 divided by inventory is something we want to compute. Therefore, the value of inventory will be how much? Inventory will be 32 lakh 62,500 divided by 7.5, which is 4 lakh 35,000. Inventory is 4 lakh 35,000. Okay, so we got the long-term debt. We've got the long-term debt. We've got the long-term debt. We have got the inventories. Now, debtors collection period is something that we are going to use. So debtors collection period is 30 days. We've got the debtors collection period is 30 days. Now, this debtors collection, is it based on certain number of days like 360 days? Yes, we are saying that we have to assume 360 days in a year. So this is something we would have got as value of sales, which is the credit sales, right? Credit sales, or rather I can say this is equal to debtors upon credit sales into 360. So 30 is equal to debtors upon credit sales. So credit sales is whatever sales we have. So total sales was 43 lakh 50,000. 43 lakh 50,000 to 360. So we get the value of debtors to be equal to 43 lakh 50,000 into 30 divided by 360, which is 3 lakh 62 500, right? So debtors is 3 lakh 62 500. That's what we got. We got the value of debtors. We have done with inventory. We have to compute now the cash balance. So we have to compute the cash balance. Now to compute, the only ratio which we haven't used is the current ratio. The only ratio which we have to use is now the current ratio. So let's look at, like, we have already computed long-term debt, right? We have computed the inventory and debtors. Now to compute the cash balance, we'll have to compute the cash balance, we have to compute, we have to do we'll have to use the current ratio. So let's say the current ratio is current assets upon current liabilities. Okay. Current ratio is current assets upon current liabilities. So current assets is something which we don't know, but we know current liability has got only one item, which is the creditors. That's amount to total 3 lakhs. So we'll say current asset. This ratio is given to be 2.9. So current assets will be inventory plus debtors plus cash. Inventories plus debtors plus cash upon, in current liabilities, in the given question we just have one item, and that's your creditors. That's equal to 2.9. So we've got the value of inventory and the debtors. Inventory is 4,35,000 and debtors are 3,62,500 plus a cash balance upon creditors are given to us to be 3 lakh. Creditors are 3 lakh. That's equal to 2.9. So 4,35,000 plus 3,62,500 will be 7,97,500 plus cash upon 3 lakh is 2.9. This is 7,97,500 plus cash is equal to 2.9 into 3 lakh, which is 8,70,000. And therefore cash balance is 8,70,000 minus 7,97,500, which is 72,500. Okay. Cash balance is 72,500. So we have got the cash balance also. Okay, so only thing left out is now fixed asset. We can definitely get the fixed asset by looking at total assets. So total assets is anyway 17,40,000. Right. So fixed assets will be equal to how much? Fixed assets will be total assets minus inventory, debtors, and cash. Total assets is 17,40,000, right? 17,40,000. Total assets is 17,40,000 minus inventory. We've got the inventory value be 4,35,000. Debtors is 3,62,500. 4,35,000 minus debtors is 3,62,500 minus cash is 72,500. This works out to be 17,40,000 minus 4,35,000 minus 3,62,500 minus 72,500, which is 8,70,000. So this is what we got, all the remaining balance sheet values. Okay, do you get it, guys? Everyone, are we all good? Did we get this? Are we all good? Did we get these answers? Fixed asset, 8,70,000, cash, 72,500. Yes. And then debtors of 362,500, inventory 4,35,000. Correct? Okay, so this is what we have done from this September 2024 exams paper. Okay. Easy? Easy, guys? You want? So, shall we take up now questions from some model test paper questions, MTB. So I've kept the model test paper in front over here. Let us take one question from here. Yeah, here we have this question. Be limited as furnished. Would you like to solve it again on the similar lines? Would you like to solve it first, everyone? Yep. Just try to solve it in rough and then we can discuss it in final form. Yeah. Okay. So it makes sense. So I'll just place the timer again. This I'm giving you, let's say, 5 minutes. So here we have the timer and the question in front of you. Get started with it, guys. Come on. Oh, sorry. This is the same question. My bad. I thought it's another question. Wait. Just give me a moment. One second, guys. Let me just pick up another question for you. Yeah, this one. Try out this question, guys. Try to solve this question. that working capital is given 2 lakh 40. Now, of course, connected ratio with that is going to be current ratio, right? So connected ratio with that is current ratio. We can definitely get the value of current asset and current liability from that. And then we have to take into account the liquid ratio to get the value of inventory. Then reserves and surplus are given. And as we follow the same format in the flow, we will first prepare a draft balance sheet. So let's prepare a draft balance sheet, okay, wherein whatever is possible, we'll try to fit into it. We have basically proprietary ratio. So proprietary ratio is going to have equity share capital and reserves. So let us say we have got equity share capital. We've got the reserves, right? Equity share capital, reserves, and then we have working capital, bank overdraft. So bank overdraft is going to be there, and since we have the current ratio, we also have the other current liabilities or maybe creditors also you can say. We have bank OD and other current liabilities. Okay, this is what on the liability side we can think of. Then on the asset side, we definitely have a fixed asset, current asset, because we are going to have the current ratio. And in that even, since liquid ratio is given, we will definitely have the value of inventory. So this is going to be having on the asset side, fixed assets, inventory, and other current assets. Okay. Now let's try to put up the values. So we have working capital and bank OD. So working capital and current ratio is going to be used. So let us use the current ratio. Current ratio is current asset upon current liabilities, right? And that current ratio is given to us to be 1.5, sorry, 2.5. This is 2.5. So therefore, we can say current asset is 2.5 times of current liabilities. Then we have the working capital. Working capital. So working capital is 2,40,000. This working capital of 2,40,000 is going to be current asset minus current liability equal to 2,40,000. Now the current asset is going to be 2.5 current liability minus current liability is 2,40,000, and therefore 1.5 times of current liability is 2,40,000. So we can definitely say current liability is 1,60,000. Obviously, total current liability is 1,60,000, out of which the question has already given us the bank overdraft value to be 40,000. So we have a bank overdraft value of 40,000. Now, obviously, other current liabilities is going to be the differential part. So other current liabilities will be current liability of 1,60,000 minus bank OD of 40,000. So this 1,20,000 may be essentially representing the creditors, but we are not so sure about it. We can just write a generic term as other current liabilities. Okay. So 1,20,000 is the other current liability. Then we have the other items, which is reserves and surplus 1,60,000. Reserves and surplus is 1,60,000, right? Reserves and surplus 1,60,000. We have obviously the left out part, which is the equity share capital. We'll discuss about that later. But right now, working capital 2,40,000 is utilized, current ratio is utilized. Now we have to use this liquid ratio. Okay. Let's use this liquid ratio. Liquid ratio, we have current assets minus inventory upon current liabilities. Okay, liquid ratio 1.5. So that's going to be 1.5 equal to total current assets minus inventory. Inventory is 40,000. So current assets is something that we are yet to compute, right? So current assets is anyways 2.5 times of current liability, which is 1,60,000 minus inventory. Inventory is something which we don't know. 2.5 into 1,60,000 minus inventory is what we have to compute upon current liability of 1,60,000. So inventory will work out to be 1.5 times of 1,60,000, right? And this is 2,40,000 is equal to 1,60,000 into 2.5, which is 4 lakh minus inventory. So the value of inventory will be 4 lakh minus 2,40,000, which is 1,60,000, right? So value of inventory is 1,60,000, and other current assets will be 2.5 times of 1,60,000, which is your current asset, minus inventory. So 2.5 times of 1,60,000 is 4 lakh. 4 lakh minus inventory of 1,60,000. So other current assets will be 2,40,000. Other current assets will be 2,40,000. Okay. So we have uh, everything ready. Only one thing is unknown, which is the fixed assets. And of course, we don't know the equity share capital. Do we have any ratio for fixed assets? Yes, we have a ratio of fixed asset to proprietary ratio of 0.7. Fixed assets to proprietary ratio is 0.75. Okay. Now, proprietary ratio will include both share capital as well as reserves. Right? So it's going to include both the things, which is share capital and reserves. So let us use the ratio of fixed assets to proprietary ratio. Fixed assets to proprietary ratio. Fixed asset to proprietary. And that ratio is given as fixed asset to proprietary ratio is given as 0.75. Okay, so this means it is going to be fixed asset upon equity share capital plus reserves is 0.7. Okay, so this means fixed asset is something which we don't know. Equity share capital, again, we don't know. But we know the value of reserves. Reserves is 1,60,000. That is 0.7. Right? So fixed assets upon equity share capital plus reserves is 0.7. So therefore we can say fixed asset is zero point 0.7 times of equity share capital plus 1,60,000 into zero point 0.7, which is 1,12,000, right? So now fixed asset and equity share capital, both the things are unknown to us. So in this situation, we can simply do one thing. We'll talk of total assets. Total assets will be fixed asset plus current assets. So fixed asset, I'm going to write it as this portion, 0.7 times of equity share capital plus current assets of 1,12,000, right? And then we have the total liabilities to be equity share capital plus reserves plus current liability. So equity share capital is something which we don't know. Plus reserves is 1,60,000 plus current liability. Total current liability is 1,60,000. This is equity share capital plus 1,60,000 plus 1,60,000, which is 3,20,000. Now, of course, the liabilities and assets should be equal. So we can say 0.7 equity share capital plus 1,12,000 should be equal to equity share capital plus 3,20,000. Now we can bring all equity share capital numbers on one side, right? So we'll definitely say 0.7. 1 second, there is some issue. Suppose equity share capital plus reserves plus reserves. Inventory is 160 and 240. This is current asset is wrong. Current assets should be 4 lakh, right? Total current assets should be 4 lakh. Yeah. It is 0.7 plus 4 lakh. Now bring all equity share capital on one side. So we have 4 lakh minus 3,20,000 is equal to equity share capital minus 0.7 equity share capital. So this works out to be 0.3 equity share capital is equal to 80,000. So equity share capital will be 80,000 divided by 0.3. It is 2,66,667. Is it? Or there is a mistake, I suppose. 1 second. 0.75. Yeah. But there's some coming after a mistake here. This is 0.75. Okay. There's a lot of confusion over here. Wait. This 0.7. Okay, why is it not working? 0.75. If it is 0.75, I need to change this. This is going to be 0.75 equity share capital plus 1,20,000. The total assets will be 0.75 equity share capital plus 1,20,000 plus current asset of 1,60,000 or 1,60,000 plus 240. So 4 lakh is the current assets. Okay. So this is 0.75 equity share capital plus 120 plus 4 lakh is 5 lakh 20,000, right? So this is also going to change once again. Total assets is 0.75 equity share capital plus 5 lakh 20. That's equal to equity share capital plus reserves of 1 lakh 60 and current liability of 1 lakh 60, totaling 3 lakh 20,000. This is minus 0.25 equity share capital is equal to minus 2 lakh, right? So we get the equity share capital to be uh, what? 8 lakhs, right? Equity share capital is 8 lakhs. And it's quite obvious the balancing part, I mean, the fixed asset is going to be on the balancing side. The fixed asset is anyways propounded to be an equation. So 0.75 equity share capital plus 1 lakh 20,000. So 0.75 into equity share capital is 8 lakh plus 1 lakh 20,000, which is fixed asset to be 7 lakh 20,000. Yeah. So this is how you complete the balance sheet. Okay. The balance sheet tallies at what value? 8 lakh plus 1 lakh 60,000 plus 40,000 plus 1 lakh 20,000. 11 lakh 20,000, right? Balance sheet tallies at 11 lakh 20,000. Did you get it, everyone? Yep. Did you get it? Yep. Okay. Fine. So this is what we have done. This question. Now, let's take a break over here. Yeah. So post break, we can definitely continue with some more questions on this ratio analysis topic. Again, from the MTP, and if possible, we can take up some questions from RTP also. Okay. So let's take a break of around 15 minutes, guys. It's 7:12, maybe around by 7:30. Before 7:30, we should be back. Okay, let's take a break, guys. See you soon. Okay. Shall we begin, guys? Okay. Now let's take up another question again from the model test papers. Hmm, is the next one that we are looking at. Okay, this is a very simple question that we have. Give it a try, guys. You're required to calculate the total current assets of Ananya Limited from the given information. So you have to compute the total current assets with the given information. Again, I would like you to solve it initially before I start with the solution. So let's say approximately 4 meter. Yeah, we have to remember, we have to calculate the total current assets. Total current assets. Okay. And whenever we have like opening and closing something is given, it simply means we're talking of the average. Stock turnover, we know it is COGS upon average stock, which is 5 times. We don't know the COGS value, neither we know the average stock. We need to compute them. So COGS is going to be sales into 1 minus GP ratio, and then divided by average stock. So we have the average stock yet to be computed, and this is going to be like 5. So we know the sales value. Sales is 7 lakh 20 and GP is 25%. So we can simply say it is 7 lakh 20 into 1 minus GP ratio is 0.25 upon average stock is something that we're going to get the answer over here. So average stock is going to be 7 lakh 20 into 1 minus 0.25. 7 lakh 20 into 0.75, which is 5 lakh 40,000 divided by 5, which is 1 lakh 8,000. So we got the average stock figure to be average stock figure is 1 lakh 8,000. And one information that we have is stock at the end is 30,000 more than the stock in the beginning. So of course, the average stock is going to be computed as opening stock plus closing stock divided by 2, which is 1 lakh 8,000. Okay. So we can simply then say that this is opening stock plus closing stock equal to 1 lakh 8,000 into 2, which is 2 lakh 16,000. Okay, so opening plus closing is 2 lakh 16,000. This is my first equation. And then we have information that stock at the end, stock at the end is 30,000 more than the 30,000 more than the stock in the beginning. So we can say closing stock, we can say closing minus opening is 30,000. Closing stock minus opening stock is 30,000. So we can definitely say that this is going to be my equation number 2. So we can simply solve 1 and 2. If we solve 1 and 2, or rather we can just say add equation 1 and 2. So once we add the equations, we can say it is opening or say this is closing stock plus opening stock. The sum is equal to 2,16,000. And the difference between closing and opening is 30,000. So if we just take a differentiated approach, the opening stock, opening gets cancelled, and we have 2 times of closing is 2,46,000. So therefore, closing stock is 2,46,000 divided by 2. 2,46,000 divided by 2 is 1,23,000. Closing stock is 1,23,000. And once you have got the closing stock, we can also get the opening stock. So opening stock is anyways 30,000 less than this. So this works out to be 90,000. So opening stock is 90,000. Now remember, we need to compute the total current assets. Obviously, we have got the closing stock. Now we need to get the debtors sort of thing. Total current assets, we need individual items of current assets. Gross profit, current liability is given as 2.4 and liquidity ratio is 1.25. Okay. So liquid ratio, let's just calculate the liquid ratio. We know liquid ratio is computed as current asset minus inventory upon current liability. And this liquid ratio is given to us to be 1.25. Now we don't know the current asset, but we know the closing inventory is 1,23,000 upon current liability. Uh, so current asset minus inventory upon current liability. So current liability is 2,40,000, which is 1.25. Therefore, current asset minus 1,23,000 is 1.25 into 2,40,000, 3 lakhs. So current asset will work out to be 3 lakh minus 1,23,000, which is, it will get added. So it will be 4,23,000. Current asset 4,23,000. Yes. Okay. So current assets 4,23,000. Are you all getting this number? Easy? Yep. Okay. Fine. Now let's go for next question. Shall we proceed, guys? Next question. Okay. So next question from this. Okay. Okay. Try out this question, guys. It's a very okay. Yeah. Try to solve this, guys. So we'll have it like, or I'll give you 6 minutes for this. Okay. Try it out. Okay. 2024 done. So we have like share capital of 50 lakh in both the years. Reserves and surplus are 20 lakh and 25 lakhs. Long-term loans are 30 lakhs. The only change is the reserves and surplus. That 5 lakh reserves and surplus is due to maybe the profits. Net profit ratio is 8%. Gross profit ratio is going to be 20%. Long-term loan has been used to finance 40% of the fixed assets. Okay, so long-term loan is going to be 40% of the fixed assets. Stock turnover with respect to cost of goods sold is 4. Debtors are representing 90-day sales. Now remember, we are talking about stock turnover, so we're going to take the average stock. The company holds cash equivalent to 1.5 months cost of goods sold. So to ignore the taxation and assume 360 days in a year. You're required to prepare a balance sheet as on 31st March 2024 in the following format. We have the format as share capital, reserves and surplus, long-term loan, sundry creditors, fixed assets, sundry debtors, closing stock, and cash in hand. So we have the outline ready in front of us as to what we are supposed to calculate. Okay. Now, coming to this part, net profit, gross profit, we can't calculate. We can't actually use these ratios unless, we get the sales. So long-term loan, again, depends on something. Stock turnover depends on COGS and sales. Debtors, again, sales. So everything depends on actually the calculation of sales figure. So how do we get that sales figure, guys? Pretty easy. You can see the reserves and surplus are increasing by 5 lakh. Right? So the reserves and surplus, as they're increasing by 5 lakh, and that 5 lakh is representing the profit, and that's nothing but the net profit ratio, which is 8%. Okay. So we have reserves and surplus. We talk of net profit. So as net profit is going to be 25 lakh, which is the closing reserves, minus the opening reserves of 20 lakh. Net profit is 5 lakh. Now the question is giving us the net profit ratio to be 8%. Net profit ratio is 8%, right? So net profit ratio stands as 8%. And this is something we know is computed as net profit upon sales. So this is 8% is net profit of 5 lakh upon a sales figure, which we are definitely not aware of. We can solve it to get the value, right? So sales translates to 5 lakh divided by 8%. How much is it, guys? 5 lakh divided by 8%. That's 5 lakh divided by 8%. 62 lakh 50,000. Sales is 62 lakh 50,000. Now, based on sales, we can get the COGS because that COGS is going to help us get the remaining values. So now we can talk of COGS to be sales into 1 minus GP. So sales is going to be 62 lakh 50,000. 62 lakh 50,000 into 1 minus GP ratio is 20%, 1 minus 0.2. So 62 lakh 50,000 into 80%. 62 lakh 50,000 into 80%, which is 50 lakhs. So once we get the COGS value to be 50 lakhs, cost of goods sold is 50 lakhs. COGS is 50 lakhs. Now we can use COGS to talk of stock turnover. Stock turnover with respect to COGS is 4, so we can get the stock value now. So stock is going to be obviously the closing stock because we don't have the opening figure as such, right? So because stock turnover, we need definitely the average stock, but we just have the information to be calculated of closing stock. We don't have information of opening and closing inventory. So whatever inventory we get over here, that we presume to be of closing, right? So we'll talk of stock turnover. Stock turnover is going to be 4. And we know this stock turnover of 4 is going to be computed as COGS upon average stock, or rather, even if you don't take the average stock, you can just write down this as stock. So 4 is equal to 50 lakhs divided by the inventory or the stock. Inventory or the stock. Inventory or the stock is going to be 50 lakh divided by 4, 12 lakh 50,000. Right? We got the inventory value with 12 lakh 50,000. Perfect. Now stock turnover is done. Long-term loan has used to finance 40% of fixed assets. So whatever is a long-term loan, that is representing 40% of the fixed assets. Okay, so long-term loan is going to be 40% of fixed assets. Now we know the long-term loan value with 30 lakhs. This long-term loan of 30 lakh is 40% of fixed asset. So fixed asset is equal to 30 lakh divided by 40%. 30 lakhs divided by 40%, it is 75 lakh. Fixed asset is 75 lakhs. We got the fixed asset to be 75 lakh. Now, stock turnover with respect to cost of goods sold is 4. This is used. This is done. Now, debtors are representing 90 days of sales, and we are going to anyways take 360 days in a year. So, debtors will be equal to sales into 90 by 360. So, sales is, we've got the sales. Sales is 62 lakh 50. So, 62 lakh 50 into 90 by 360. So, the value of debtors is 62 lakh 50,000 into 90 divided by 360, which is 15 lakh 62,500. 15 lakh 62,500. Okay. Then the company holds cash equivalent to 1.5 months of cost of goods sold. So you can get the value of cash also. So cash is 1.512, 1.5 by 12 into COGS. 1.5 by 12 into COGS, which is 50 lakh. 1.5 by 12 into 50 lakhs. 50 lakhs into 1.5 by 12, which is 6 lakh 25,000. So cash is 6 lakh 25,000. Okay, this is done. Share capital is anyways given to us. Reserves or surplus given, long-term loan is given. The only thing unknown is the sundry creditors. Now we can get the sundry creditors by simply taking the total of assets. The total of assets is 75 lakhs plus 15 lakh 62,500 plus 12 lakh 50,000 plus 6 lakh 25,000 is 1 crore 9 lakh 37,500, from which we are going to subtract the share capital reserves and other aspects. So from this we will subtract, total is what, 50 plus 30 80 and then 105, 1 crore 5 lakhs. So you get the value of creditors to be 109,37,500 minus 1 crore 5 lakhs. Sorry, 109,37,500 minus 105,000, 1 crore 5 lakh. One second, there is some problem. 1 crore 9 lakh 37,500 minus 1 crore 5 lakh. 1 crore 5 lakh. So, 4 lakh 37,500 is the value of the creditors. Did we get it? Okay, you have one doubt, Tejaswin. Tejaswin Marwa, yes, you can proceed. You can ask your doubt. Proceed and ask your doubt, guys. Yeah. What is Q ratio? Okay, Q ratio is simply the relation between, by the way, Acha, can you just tell me what is the formula for Q ratio? Let me test you on that first. What is the formula for Q ratio? What's the formula for Q ratio? Yeah. Formula for Q ratio is market value of company divided by replacement of company. Perfect. So market value of the company, as you said, this is market value of company upon replacement value of company. Okay. Now, market value of company will be market price per share into number of equity shares. This is the net. This is the value of the company which is having in the market, right? So this is the value at which the company is trading in the market. So that's going to be market price per share into number of equity shares. That's market value of the company divided by replacement value of the company. Now, replacement value, what do we really mean by replacement value? See, suppose market price of the share is 105 and there are 1 lakhs, or let's say 10,000 such shares. So this definitely becomes like, 10 lakh 50,000 is the market value of the company. Now, if we go deep down into the company's balance sheet and we just dig into it and we find out that what all assets and liabilities it has got, and I want to know what is the cost that will be incurred. I want to know what will be the cost that will be incurred if I am looking for, what is the cost that is going to be incurred if I'm going to replace all these assets from the current market. So, like whatever is the machinery, whatever is the building, whatever is the furniture, the infrastructure that the company has got. If I want to create a similar infrastructure, similar company today, what is the cost that I'm going to incur? And from that, you're going to reduce the depreciation. And when you do this sort of adjustment, that is current value of creating such a company, and after depreciating it, that's what we call it as a replacement. That's simply what we are really looking for, the replacement value, right? So today, if I want to create a similar company, let's say to buy all those assets and excluding all the liabilities and everything, that is going to be incurring a cost of, let's say, 90 lakh. So the Q ratio will be what? 10 lakh, 9 lakh, sorry. Q ratio is going to be 10 lakh 5,000 divided 10 lakh 50,000 divided by 9 lakh. So market value is, it's a ratio of at what price the company is being traded in the market and what is its value today. And what is its value in the replacement form. Okay. Yeah, Tejaswin? We get it, Tejasvi? Yeah. It's market value of the company and you divide it by the replacement value. So can we say the market value of total assets minus outside liabilities minus depreciation? Yes, you can say it's market value upon total assets, but total assets at current value basically. Okay, perfect. So let's take up one last question for the day before we call it a day, because we still have around what 25 minutes to go. So let us take up another question. Mm. Yeah. So try out this question, guys. Okay. Try out this question, guys. So here we remember we have to calculate, we have to get the summarized P&L as well as balance sheet. Okay, so just taking that into account, I would like to give you, let's say, around 7 minutes for this. Try to solve it in a rough way, guys, quickly. Okay, so if I have dot second question, total asset turnover ratio. Total asset turnover ratio in my notes, I have written as sales or COGS upon total assets. Uh, for total assets, generally it's going to be sales upon total assets. Okay. But if the question specifies to use COGS or if there's no information about the total sales, then you can use COGS. Okay. But primarily it has to be sales upon the total assets. Okay. Okay, so this is data pertaining to Anya Company Limited. Prepare its trading P&L account for the year ended 31st March 2024 and a summarized balance sheet. You have current ratio, quick ratio, proprietary ratio, gross profit to sales, debtors, velocity. This is nothing but debtors collection. Okay, sales, working capital, bank OD, share capital. Closing stock is 10% more than the opening stock. Net profit is 10% of the proprietary funds. Okay, so let's just prepare the format of P&L. P&L generally we should prepare it in a vertical format because it's easier for us to put in the data. So we have sales less we are going to subtract. We have the gross profit ratio, so we can definitely subtract COGS. We get the gross profit number. Right? From that gross profit, we are going to subtract other expenses, right? And then we have the net profit number. Sales less COGS, that's your gross profit, less other expense, going to be the net profit. Now, in this, we have got the value of fixed assets. I need to put in the value of fixed asset. Then, since we have working capital, bank OD, and debtors quick ratio is also given. We'll talk of inventory, right? And debtors value is also going to be obtained. And then other current assets. On the liability front, we have got proprietary, I mean, share capital is there. Reserves is something that we need to compute. Long-term loan, there doesn't seem to be anything, but yes, we have a bank OD. And obviously the other thing is going to be other current liability. So whatever values are available, let's just try to put it in. So bank OD is 15,000. Share capital is 2,50,000. Share capital is 2,50,000. Bank OD is 15,000. Share capital 2,50,000. Bank OD 15,000. Now let's try to look at these numbers. Like current ratio is 2.5. Working capital is 1,20,000. So we have a current ratio. Current ratio numbers are 2.5. This 2.5 is going to be current asset upon current liability. So this 2.5 is equal to current asset upon current liability. You don't know, so we can definitely say current liability is current asset is 2.5 times of current liability. Then we have the working capital number as 1,20,000. And we know this 1,20,000 is current asset minus current liability. So 1,20,000 is 1,20,000 is current asset of 2.5 current liability minus current liability. Okay, so 1,20,000 is equal to 1.5 times of current liability. So current liability will work out to be 1,20,000 divided by 1.5, 80,000. Right? So if it's 80,000, of course, the other current liability is going to be 65,000. And the current asset will be 2.5 into 80,000. This into 2.5, which is 2 lakh. Current asset value, total it is 2 lakh. Okay. Then we will use the quick ratio. The quick ratio is going to be current asset minus inventory or stock upon current liability. Quick ratio is given to be 1.3. So that's 1.3 is equal to current asset, which is 2 lakh, minus stock. Stock is basically value which we need to get upon current liability of 80,000. So 80,000 into 1.3 minus 2 lakh. So stock is 96,000. The inventory is basically 96,000. Then debtors collection period is 40 days. So for that, we will need the value of sales. Sales is anyways given to us 7 lakh 30. We have debtors collection period to be calculated as what? Sales. It's going to be debtors. But wait, there's a problem over here because I cannot take the inventory directly because closing stock is 10% more than opening stock is given, right? So what we got this as 96,000. This is a closing stock, right? Yeah, sorry, so 96 closing stock, we can definitely place it. My bad. And opening stock, closing stock is 10% more than opening stock. So opening stock, or rather, as the question says, closing is 10% more than opening. So closing is basically 1.1 times of opening. That's 1.1 into 96,000. Sorry, it's 96,000. 96,000 divided by 1.1. That comes out to be something weird. Closing stock is 10% more than the opening stock. So it's 1.3 current asset minus stock. Current asset was 2 lakh minus stock, and then current liability is 80,000. We got closing stock to be, is it perfect? Just check. 1.3 into 80,000 minus 2 lakh, 96,000. Yes. So closing is going to be 10% more than opening. Closing is going to be 10% more than opening. The question is saying that closing stock is 10% more than opening stock, right? So it's 10% more than opening stock. So of course, the opening stock is going to be computed in this manner. So opening stock is going to be 96,000 divided by 1.1. That's 87,273. Okay. We don't need the opening stock anyways over here. But yeah, debtor velocity is 40 days. And we have the sales value to be 7 lakh 30. Debtor velocity is 40 days. So we'll talk of debtors collection period. Debtors collection period is obtained as debtors upon sales into 365. So debtors collection period is, or debtors velocity is 40. And we have the debtors upon sales value is 7 lakh 30 into 365. So debtors will be 7 lakh 30,000 into 40 by 365. That's 80,000. That's the value of debtors. We have the debtors as 80,000. But remember, we know the total current assets is 2 lakh. If total current assets is 2 lakh, it's going to be 2 lakh minus 96,000 inventory minus 80,000 debtors. This is 24,000. Other current assets is 24,000, right? Um, then we have proprietary ratio is okay. Net profit is 10%, they're saying. Proprietary ratio, which is fixed asset to proprietary funds, is 0.6. So here, again, we have to use it by the similar way, by forming an equation and then solving it. So we say total assets should be equal to total liabilities. It's a total assets is fixed asset plus the current assets, fixed asset plus current asset, and total liabilities is going to be no share capital plus reserves plus current liability. And since we have a ratio of fixed asset to proprietary fund, fixed asset to share capital plus reserves, this ratio is given as 0.6. So you can say fixed asset will be equal to 0.6 times of share capital plus reserves. This is 0.6 into share capital is 250 plus reserves is something which we don't know. This is 0.6 into 250. This is 150. 150,000 plus 0.6 times of reserves. That's your fixed asset. Fixed asset, I can say it is 150,000 plus current asset is 2 lakh. Fixed asset is 150 plus 0.6 reserves plus current assets of 2 lakh is equal to share capital is 2 lakh 50 plus reserves is something which we don't know plus current liability. So current liability is computed by us is 80,000. Let's take numbers on one side. So 1 lakh 50 plus 2 lakh is 3 lakh 50,000 plus 0.6 reserves is equal to 2 lakh 50 plus 80. 3 lakh 30,000 plus reserves. Taking all reserves on one side, we can say here it is 20,000 is equal to 0.4 reserves. So reserves will be 20,000 divided by 0.4 is 50,000. So once we get the reserves value as 50,000, and the fixed asset can also be obtained as 1 lakh 50 plus 0.6 of reserves. So 0.6 into 50,000 plus 1 lakh 50,000, which is 1 lakh 80,000. Okay. Finally, coming to sales, they say net profit is 10% of profit. Sales is anyways given 7 lakh 30,000. Gross profit is 73,000. 7 lakh 30 minus 73,000. Which is 6 lakh 57,000. Net profit is anyways 10% of proprietary funds. 10% is basically 30,000, right? Because it's 2 lakh 50 plus 50. So 3 lakh. Of that 3 lakh, we get the net profit of 30,000. And then the difference is 43,000 is going to be other expenses. Okay. Yep. With that, we are done with this particular question, and also we are at the end of our today's session also. Okay, guys. So let's just call it a day for the time being. See you again in the next week with a new topic. Again, we'll be doing a lot of questions for practice and for revising the concepts of the next week. Bye bye and take care, guys. Good night. Over.
Recording stopped.